All right, let's take a look at accounts receivable and allowance for doubtful accounts. You're going to see this abbreviation, AFDA, or you may see this abbreviation, AFDA, Allowance for Doubtful Accounts. That's the amount of accounts receivable that is not going to be collected. So when we record accounts receivable and revenue, it's like, well, we did the work, we sold the product, we're sending a bill, we're sending an invoice to the customer, and of course they're going to pay. But no, not everybody pays. So this section with accounts receivable and allowance is basically a reality check on accounts receivable on the balance sheet. If we simply report accounts receivable on the balance sheet at the full amount, that's not really realistic or transparent. So with accrual accounting, what we do is we say, yeah, we're going to estimate how much of that accounts receivable balance is not going to be collected, and we're going to call it allowance for doubtful accounts. Okay, so we're going to look at two ways to do this. The percentage of sales method, students would say a little easier, and the percentage of receivables method, students would say, yeah, there's a little more work to do here. So I want to start with my sort of summary of how to do these two methods. When you're doing the percentage of sales method, you're solving for bad debt expense. And this is how you do it. You do sales times the percentage of sales method. Sales times the percentage. And when you get whatever number you get bad debt expense. When you're doing the percentage of receivables method, big surprise, you're going to take receivables times a percentage of receivables method, receivables times a percentage. And when you get whatever number you're going to get the ending balance and allowance for doubtful accounts. So when you're doing this method, you really need to do a T account for allowance for doubtful accounts to see where you were and where you need to be, and so there's like an extra step here. But basically you're going to be doing some math. I know you can do the math, and you're going to do a little account analysis, and I know you can do that. My hint down here is percentage of sales method, bad debt expense, sales expense is an income statement account, sales is an income statement account. That's my hint. So percentage of sales is income statement focused. Sales, expense, revenue, expense, income statement. The percentage of receivables method, allowance is a contra asset. Accounts receivables an asset. Those are asset accounts. Those are balance sheet accounts. So the percentage of receivables method is a balance sheet focused method. So for some students, that kind of big picture hint is really helpful. But here's the nitty gritty, and we may come back to this as we get rolling. So there's not really a whole lot of work to do. We've got, here's a whole problem, it's one journal entry. Here's another whole problem, one journal entry. When we get into percentage of receivable with aging, we'll have a little table to finish off and a T account and a journal entry. So this work is perhaps smaller in scale than some of the other things we've been doing. All right, let's take a look at an example. I'm going to blow this up a little bit, and we're going to be looking at this one right here. Maybe I should highlight it or something. We're going to be doing that one. Your company uses the income statement approach. Income statement approach, that's this. Blah, blah, blah. Sales are 1 million, and the estimated percentage is 0.5%. So we might need to have a discussion about how to use a percentage. Prepare the journal entry to record bad debt expense for the year. Okay, let's say you've never seen this before. They said year end, so we're going to do year end, and the journal entry to record bad debts is bad debt expense. Shocker, right? It's one of those times in accounting where it makes sense. Okay, and then the offset is your AFDA, and I'm going to type it out. Allowance for doubtful accounts, and that's exactly what it is. This is a contra asset, so we're going to have on the balance sheet, let's add this over here. You're going to have accounts receivable and some number. And then you're going to have allowance for doubtful accounts, some number. And then you're going to have your net receivable, or like the realistic amount that you're going to collect. So those are just some made up numbers. Asset, contra asset, net asset. Maybe I want to put a negative sign in there so you see it as a negative. Maybe I want an auto sum here. Maybe I want to jazz this up and make it currency. You know, it would be even cooler. You know, here you can pick, that's not what I want. I want here and more number. I'd kind of like to see that in red. See that? I can make it pop up in red. Yeah, like that. So that would be balance sheet presentation, asset, contra asset, net asset, debit, credit, debit, as far as balances go. Okay, so here's the journal entry to record bad debt expense. This is an adjusting entry. This is end of the month, end of the quarter, end of the year. Record increase expense. Record increase credit allowance, contra asset, credit. And then how much, right? Now we need an amount. So percentage of sales. Sales is 1 million. Watch your zeros. 1, 2, 3, 1, 2, 3. Times 0.5%. Now if I do 0.5, that would be 50%. If I do 0.05, that would be 5%. I need 0.5%, so I need 0.005. How did I do my F2? There we go. There's my F2. So 1 million sales times the given provided estimated percentage of sales. So they're going to give us this information. We have to. In these problems, it has to be given. If it wasn't, we would go and look it up. Or it could be your job to do a study, to do a cool little analysis and come up with that percentage. Review on percentages. Let's do the one I just did. I'm going to use apostrophe. 0.5 equals 50%. 0.05 equals 5%. 0.005 equals 0.5%. So if you get turned around at all on your percentages, write it out, keep it simple, think it through. Remember, you're moving the decimal place 2 spaces over. Okay, that's it. We're done with this problem. All set, all done. Let's go on to the next one. So that was percentage of sales. Solve for bad debt expense. We did this calculation. That number is bad debt expense, and we're done. Okay, let's look at the next one. Your company uses the allowance method. Okay, this is all allowance method. Company had credit sales, 328 currently owed. Let's talk about those two numbers. 1,370,000, that's sales. Credit sales means accounts receivable and sales. So, okay, not cash sales, but accounts receivable and sales, which is important, right? Because that's what we're looking at, is how much of our accounts receivable is going to be collected. So that's that number. This number, currently owed by customers. Currently owed by customers is another way of saying accounts receivable. This is accounts receivable. According to historical standard, 2.5 uncollected. Income statement approach. Income statement approach. Income statement, percentage of sales. Prepare the journal. Okay, try it. I will pause. Give this one a whirl. What do you think? Percentage of sales. It doesn't matter which order you could do the percent or the sales or whatever. Here's sales. And here's the percent. Not 0.25, 0.025. Cell reference. Now, these two companies were about $1 million in sales. This company is saying, yeah, we don't really think this is going to be much of a problem. 0.5% is our estimate, based on our history. This company's like, yeah, a lot of our customers don't pay. Or more, a greater percentage, 2.5%. So notice that the result is very different, but they're similar companies, 1 million, about $1 million in sales. Let's look at the next one. Allowance method. Yeah, whatever, these are all allowance method. Income statement approach. Income statement approach. Credit sales. Ooh, we're up to 2.3 million. 1.5 uncollectible. All right, give it a whirl. Oh, I should have copied that whole thing down. Sales. Estimated percent uncollectible. Wouldn't it be kind of interesting to do that study? To come up with the 1.5%, to go back through and review all the sales and all the receivables and who paid what and when. And yeah, somebody sweated it out to figure out that estimated 1.5%. And now look at where we're at. Now we're double the sales, but like half the amount uncollectible compared to the one we just did. So that's kind of interesting. All right, so that's it for percentage of sales method. Let's move on to percentage of receivables method. Now, you might be thinking, boy, this is super easy. But when you look at the second method, what I've seen is students start mixing up the two methods, so don't. Make sure you're solid on this one, and remember this one's different. Different method, different approach. Percentage of receivables, solve for the ending balance and allowance for doubtful accounts. Maybe we should add that. Solve for ending balance and allowance for doubtful accounts. Okay, so let's see how this kind of method goes. Balance sheet approach. Okay, yeah, this is the other method. Details of receivable in this little table. Okay, so we're going to calculate in the table, and then we're going to do the journal entry. And to do all of that, do the T account. Just do it. In Excel, throw it in there on a piece of paper, scratch it out, do the T account analysis. Okay, so this is given. What you see up here would be given. I added these two little tags up here. So aging category. What's that? Bad debt percentage. I think I might know what that is. Balance. Balance of what? So this is called an aging of accounts receivable. This is an aging of accounts receivable. Aging. So total accounts receivable is $210,000. And we're looking at, well, what are the balances in there? Like, what are the invoices and the invoice dates? Like, under 30 days means we just sent the invoice out less than 30 days ago, and it's not even due yet. So 90,000 of, about half of it isn't even due. Customers, are, opening their email and their mail and organizing, what they're going to pay us. And so, yeah, not an issue at all. 31 to 60 days means that invoice was sent out over a month ago, and we've been expecting to receive payment from customers for over a month. Okay, so this is a little delay here. And we're saying, yeah, 20% of those people aren't going to pay. Well, once you get into this, there's a little delay here, 1 in 5 aren't going to pay. Notice that the ones that we just sent out were like, yeah, no, this is still in the range of no problem, and pretty much everybody's going to pay. We're only saying 1% aren't going to pay. And then look at more than 60. Now we're into a couple of months. Like, we did the work a couple months ago. sold the product a couple months ago, sent the bill, the invoice, you know, and and so this estimate for this company is, you know, half of these aren't going to pay. Honestly, these are a little bit high, and it's better to go out to say 6 months or even a year for aging. But this one's pretty simple. It's just got 3 categories, 3 estimates for uncollectible or for bad debt, and this is our accounts receivable in each category. So this is called the percentage of receivables method. Just want to make sure these are formatted as percents, and they are. So when I do equals this times this, you know, and I'm kind of checking myself like, yeah, that looks right. And I can do a fill handle here. I just want to make sure it's multiplying the way I want it to multiply. Otherwise, I would type equals 90000 asterisk 0.2, that kind of thing. But these are formatted as percentages. And an auto sum to add up here. Okay, so when I do that, I did my percentage of receivable. Up here, I did receivable times percent. I just had 3 of them, you know, in this table. That's no big deal. So I did 3 of these, and I added them up. And I just calculated the ending balance and allowance for doubtful accounts. So this number right there is this number right here. Well, that's fine. This is this. If I could quick and draw an arrow, I would draw a little arrow. Whoop, right there. Multiply percentage of receivable. I know you can multiply. Add. When you get your number is the ending balance and allowance for doubtful accounts. Okay, but we're supposed to be doing a journal entry. Let's put this journal entry together. So is this a lot? Is that? No, this is not 33,900. The ending balance in the account is 33,900, but somewhere in here is going to be this amount here. Like, what was the change? This is the change in that account, which is going to go here. This is the ending balance in that account. Okay, we need more information. So we're good here. Got this set up and ready to go. Oh yeah, we need more over here. Assume that the allowance account had a $20,000 credit balance. Okay. Bam. Okay, now we're cruising. So this was given, and this is the beginning balance. This was calculated, and this is the ending balance. We have to figure this out. I call this a plug. A plug means we got this one, and we're going to plug this one in. We're going to solve for the unknown. So we got 20 credit plus some other credit equals this bigger credit. So we need to subtract. We need to find the difference between those two. And then look at it. 20 plus, 13. Good. So this is the adjusting journal entry. AJE is adjusting journal entry. So credit, allowance for doubtful accounts, 13,900. Go ahead and finish off that journal entry. We're solving for, all of this is solved for ending allowance. Then analyze the account, compare your beginning to your ending, figure out what happened, what the change was. Here's that change. So that is the percentage of receivables method, or the balance sheet approach to estimating uncollectible accounts. Is there anything else we want to add in here? I guess not. I mean, it's all kind of here. But remember, this area over to the right is for your notes. It's for anything that you want to add in there that helps you remember, okay, this is what I did here, or there, or there, or here. Okay. Now, that was a little bit more work, right? So we're going to do one more of those. Let's do one more percentage of receivables. We got a little bit more going on. Let's read the whole thing first. I didn't do very well with that last time. Okay, we got another aging table. Yeah, balance sheet, percentages, aging, accounts receivable. Yep. Assume that allowance has a debit balance of 1100. Well, we could put that in right now. Wait, it's a debit balance. Oh, interesting. And that can happen. So depending on the other transactions affecting accounts receivable and allowance, like if somebody goes bankrupt and you got to write something off, or I mean, there's all kinds of things that could happen. You could end up with a debit balance. This one was a credit balance. And if you want to, you could say the same sort of thing here. Maybe you want that, maybe you don't. Okay, so off we go. Percentage of receivables. I'm checking those are formatted as percent, so I can do my multiply. Percentage of receivable, or receivable times the percents given, multiply and add. Okay, I just solved for ending allowance. So ending allowance is 5595. Let's finish off that T account. We need to know what this number is, however you want to look at it. Really, it's going to be this number. Plug, solve, maybe solve is a better word. We've got a debit. We need some kind of credit to end up with a credit balance. We calculated this was ending. So how do we get this number? You know lefts and rights, and you know how to add and subtract, so you can do it. We got to get from a debit balance all the way over to a credit balance. So this needs to be a bigger number. So if this is a bigger number, this is bigger number credit, subtract littler number debit so that we end up with a credit. So we need to add. And then let's look at it. So 6695 and then subtract about 1,000 and yeah. Yep, and this is the adjusting journal entry amount. Let's get that adjusting journal entry in there. Oop, I'm missing the top. There we go. And so there we are, we're good to go with our second aging percentage of receivables balance sheet method approach. So two methods, two things to consider here. I would definitely start with percentage of sales and just kind of, like a warm-up. Get that in you. That's the easier one, maybe the more straightforward one. And then move on to the percentage of receivables. And remember, they're separate. And you're solving for two different things. All right, very good. Nice work today. Talk to you next time.